Welcome to the deep dive, the weekend edition of Bulls, Bears, and the Bell. We are really getting into it today. We're looking back at maybe the most significant week for the markets this year.
Yeah, absolutely. September 15th through the 19th, just packed with action, record highs, Fed moves. A lot to unpack.
Exactly. It felt like everything happened at once. So our goal today is to break down what drove all this. We've got a ton of research here covering the big catalyst, obviously the Fed cut. And we want to trace how that played out. The records, the way sectors shifted around, some really wild company news, and of course the AI boom just keeps rolling.
And I think the main thing, the core takeaway right from the start is this huge disconnect. The market roared higher, S&P, NASDAQ, third week of games, definitely a risk-on feeling.
Totally risk on.
But, and this is the crucial part, that bullishness, it's sitting on top of some really contradictory economic signals, like deeply contradictory.
Okay, so the market's celebrating, but the foundation might be a bit shaky.
That's putting it mildly. The market's basically priced in this perfect scenario, a soft landing. But the actual data that made the Fed cut rates, that points towards, well, fragility, weakness starting to show.
And that tension, that's where it gets interesting, right? The soaring stocks versus the potentially weakening economy. Okay, let's jump into part one, the macro story. The Fed's balancing act really set the stage for everything.
It really did.
So, the main event, the Fed meeting, they cut rates, which, everyone pretty much saw coming, didn't they?
Yeah, the market had it pegged at, 96% probability, so
Yeah.
no surprise on the actual decision. The FOMC finished up, announced the cut, first one of 2025.
Right, 25 basis points, 0.25%.
Yep, knocking the top end of the Fed funds rate target down to 4.25%. So the action itself, expected.
But it was the way they talked about it, wasn't it? Like, Chair Powell's language seemed carefully chosen. He wasn't exactly doing a victory lap.
Not at all. That's the critical piece here. Powell made a real point of calling it a risk management cut, not, the start of some pre-planned easing cycle.
Risk management. Okay, what does that translate to in plain English?
It's Fed speak for, look, we're seeing some worrying signs, specifically on the jobs front, and we're acting cautiously because of that data. It's defensive. It's data dependent.
So not everything's great, let's cut rates, but more like, uh-oh, maybe we need to ease off a bit because things are slowing down.
Exactly. And you saw that caution reflected in their own projections, too. The summary of economic projections showed some disagreement internally, suggested maybe only a couple more cuts this year. They're trying really hard not to promise too much or risk inflation flaring back up.
Okay, but hold on. If Powell's being so cautious, saying risk management, why did the market immediately start pricing in like 3 or 4 more cuts over the next year? Seems like they didn't really buy his cautious story.
That's a fantastic point. It absolutely shows the market thinks the Fed is behind the curve. Investors are basically saying, yeah, risk management, whatever. We think the economy's slowing down faster than you admit, and you will have to cut more aggressively, regardless of what you're saying now.
So the market's calling the Fed's bluff, almost.
In a way, yes. And that leads us straight to the reason why the Fed felt they had to cut. The labor market data. This was the bombshell.
Right. This is the number that I think really floored people. It wasn't about inflation suddenly getting better. It was about jobs looking weaker. And the BLS revision, just wow.
Yeah, the annual benchmark revision from the Bureau of Labor Statistics. If you remember one number from this week, this is it. They revised previously reported job growth downwards by a massive 818,000 jobs.
818,000 just vanished from the previous reports.
Vanished, erased from the historical record. Think about what that means. Our whole perception of the labor market over the past year or so was based on numbers that were significantly overstated.
So we thought we had this incredibly strong, resilient job market.
And it turns out it was decelerating much, much faster than anyone realized. That revision gave the Fed all the justification they needed. It basically confirmed the downside risks Powell was talking about.
And there was other data pointing that way too, right? Jobless claims.
Yep. Initial jobless claims ticked up. And the Challenger, Gray, and Christmas report showed corporate job cuts rose for the second month straight. So analysts are shifting their language. It's not robust anymore. It's more like stall speed.
Stall speed. Okay. So the Fed cuts because jobs data looks shaky thanks to this massive revision. But that leads us right back to the big problem. Inflation hasn't gone away.
And that's the tightrope. Exactly. Inflation is still sticky. Still above that 2% target the Fed wants. We got the August CPI numbers this week.
Right. How did those come in?
Pretty much as expected. Headline CPI year over year was 2.9%. Okay, under 3%, but still high. But the core CPI, stripping out food and energy.
That's the one the Fed watches more closely, right?
Yeah, arguably. And that was actually higher, at 3.1% year over year. Still sticky. And even producer prices, the PPI, showed a 0.3% jump month over month. So costs are still rising at the wholesale level, too.
So the market's cheering lower rates, but those lower rates are happening while core inflation is still running over 3%. Where's that stickiness coming from mainly? Services.
Yeah, mostly services and shelter, rents, things like that. And those are the parts of inflation that are really tough to bring down quickly just by hiking rates, or in this case, by just starting to cut them.
And this is where the warnings come in, right? The big institutional players saying, hang on.
Exactly. You had firms like Apollo Global Management putting out notes basically saying, be careful. Easing policy now, while inflation is still this high, especially core inflation, it risks letting the inflation genie out of the bottle again. They actually drew parallels to the 1970s.
Oof, the 1970s comparison, that's always scary. Stagflation fears.
It is.
Yeah.
Because the worry is, what if the labor market just stabilizes here? Doesn't get much worse, doesn't get much better. The Fed might have to pause its cuts. But if inflation stays sticky or even ticks up because they already eased, that's a policy nightmare.
Yeah, a real double-edged sword. So it really highlights this split in the economy, doesn't it? Some parts strong, some parts clearly weakening.
Totally. A divided economy. You've got clear resilience in some
I say
areas.
consumer, still spending.
The consumer is still the anchor, surprisingly. Retail sales for August, up 0.6% month over month. And they revised July's number up to 0.6% too. So despite everything, people are still out there buying things.
Holding up better than expected, maybe. But the other side, the production side, the interest rate sensitive stuff, not looking so hot.
Definitely weaker. Industrial production barely nudged up, and that was after downward revisions to previous months. And housing. Housing is a major drag right now.
We saw that with builder confidence numbers, right?
Yeah, builder confidence is hovering near cyclical lows. New construction housing starts, building permits both fell. There's too much inventory sitting there. And buyers are hesitant because mortgage rates, even with the Fed cut, are still pretty high. Affordability is just a massive issue.
And we saw that directly impact a company later in the week, didn't we? Lennar, the home builder.
Yep. Lennar reported earnings, missed expectations, and they specifically said they're having to offer more incentives to get buyers across the line.
What kind of incentives are we talking about? Like throwing in a free toaster oven?
A bit more than that.
Right.
We're talking about things like buying down the buyer's mortgage rate for the first year or two, offering significant credits towards closing costs, maybe upgrades on appliances or finishes, stuff that directly eats into lenders' profit margins.
So they're having to cut their profits just to make sales happen? That tells you a lot about buyer hesitancy.
It really does. It shows how stretched affordability is.
So you mentioned BlackRock calling this a fork in the road. The market seems to have already zoomed down the soft landing path, judging by the records.
Yeah, the market action is pricing imperfection. It's assuming this gentle slowdown in jobs allows the Fed to cut rates just enough to keep the AI party going without reigniting inflation, the Goldilocks scenario.
But the reason for the cut was weakness. That's the fork.
That's the fork. What if that fragility, the thing that prompted the cut, actually gets worse? Then the Fed has to cut much more aggressively, maybe signaling a real recession is coming. Or, the other side, what if the labor market surprisingly strengthens again? Then the Fed might have to slam the brakes on cuts, maybe even reverse course. The market's current altitude feels like it's ignoring those other paths.
It's banking entirely on threading the needle perfectly.
Pretty much a very narrow path they're hoping for.
Okay, despite all that macro uncertainty, that tightrope walk, the market itself just, well, it exploded higher. Let's get into those index numbers in part 2. They really tell the story of the week's mood.
Yeah, the mood was pure conviction, pure risk on, third straight week of gains for the big guys.
The S&P 500, the broad market measure, smashed through 6,600 for the first time ever. Closed Friday at 6,664.36. That's a gain of, what, about 0.75% for the week?
Yep, plus 0.74%, pushing the year-to-date gain up nicely, around 14.1% now. Solid.
But the real star was the NASDAQ, right?
Yeah.
Tech-heavy, growth-focused.
Oh, absolutely. The NASDAQ composite just flew. It surged plus 2.2% for the week. And get this, that was its 6th consecutive record close. Just relentless buying pressure there, fueled by the lower rate hopes and that AI narrative.
6 record closes in a row. Incredible. And the Dow Jones?
The Dow did well too, up plus 1.0%. And importantly, it wasn't just the mega caps doing all the work. Market breadth was actually pretty good.
Meaning more stocks were participating in the rally.
Exactly. 10 out of the 11 S&P 500 sectors finished the week higher. And even small caps, the Russell 2000 index, they posted gains too. That's significant because small caps are usually more sensitive to borrowing costs, so seeing them rise suggests investors really believe lower rates are coming and are willing to take on more risk.
So when small caps join the party, it signals broader confidence.
It's a classic sign of a risk-on rotation, which brings us perfectly to the sector spotlight, because the difference between the winning and losing sectors this week was stark. It really showed where the money was flowing.
Okay, let's break that down. Who are the big winners, the risk-on leaders? Where did investors put their chips?
Unsurprisingly, number one was information technology, XLK, up plus 2.42%. I mean, this is ground zero for the AI boom. Chip makers, software, hardware, they all benefit from lower rate expectations and just the sheer amount of money pouring into AI infrastructure.
Makes sense. Who is number two?
Right behind tech was communication services, XLC, up plus 2.38%. Now, this sector sounds broad, but it's dominated by a few giants.
Like Google.
Exactly. Alphabet, Google's parent company, had a monster week. It actually crossed the $3 trillion market cap milestone.
$3 trillion. Just staggering.
It really is. So communication services benefits from digital advertising, streaming, and its own huge investments in AI.
Okay, tech and comm services leading the charge. What was the third big winner? Kind of surprising, maybe.
A little bit, yeah. Industrials XLI had a strong week. This is your classic cyclical play. Seeing industrials do well suggests investors are betting the economy isn't going to completely fall apart. Lower borrowing costs help them too, and we had some good news like FedEx reinstating its guidance.
So tech, comms, industrials, all pointing towards growth and maybe a bit more economic optimism than the Fed's caution would suggest.
That's the market interpretation for sure.
Now let's flip it. Where did the money come from? Which sectors got left behind? These are usually the defensive plays, right?
Textbook defensive rotation out. The worst performer was real estate, XLRE, down negative 1.53%.
Wait, real estate? Shouldn't lower rates help real estate? That seems counterintuitive.
It does, right? Normally, lower borrowing costs are good for REITs. But its terrible performance tells you that the deep, deep worries about commercial real estate, especially offices, maybe retail too, are just overwhelming any benefit from slightly lower rates right now. The market sees serious trouble in CRE.
But wasn't there a pocket within real estate that actually did well, related to AI?
Ah, yes. The exception that proves the rule. Data center REITs. They were actually up 3.6% for the week.
Wow. So even within the worst sector, the AI theme created winners.
Exactly. If you own buildings that house servers for AI, you're golden. You own empty office buildings? Not so much. It's a completely bifurcated market.
Okay, so real estate was the worst. What else lagged? The classic safety sectors.
The consumer staples, XLP, was the second worst, down again at 1.49%. This is your Procter & Gamble, Coca-Cola type stuff, necessities. Slow, steady growers. When investors feel bullish and want growth, they sell staples and buy tech. Classic risk-on move.
Makes sense. And utilities.
Utilities, XLU also lagged. Same story. People rotate out of these high-dividend, traditionally safe sectors when they're chasing higher growth potential elsewhere.
Oh.
So the overall sector picture, clear message. Risk is OUN, safety is OUT.
Okay, that sector rotation is clear. But let's get even more granular in part three. The individual stock movers were just wild this week, some absolutely enormous gains.
Yeah, the company-specific stories really highlight the themes we've been talking about: AI, strategic partnerships, energy transition.
Let's start with the absolute rocket ship of the week, Plug Power, PLUG. Up, get this, 43.09% in 1 week. What on earth happened there?
It was a perfect storm, really. First, they locked in a long-term deal, extending their partnership with Uline, the big shipping supply company, out to 2030. That provides revenue visibility.
Okay, good baseline news.
Then, they announced a brand new collaboration with a group called GH2 Global. This is focused on building out hydrogen infrastructure for logistics down in Brazil. So, geographic expansion, new market application.
Right, expanding their footprint.
And then on top of that, you had analysts jumping in, highlighting that their sales of electrolyzers, hydrogen tech, had actually tripled year over year in Q2. So it felt like the story was shifting from just potential to actual execution.
Okay, momentum plus tangible deals. Got it. Now switching gears to biotech, Intellia Therapeutics, NTLA. Another huge jump, plus 36.51%. What drove that?
Pure clinical trial news. Good news. They announced that enrollment for their big phase 3 trial called Magnitude, it's for a genetic heart condition, is moving faster than they expected.
And why is faster enrollment such a big deal for a biotech stock?
Because for these companies, hitting clinical milestones is everything. It de-risks the drug, brings potential revenue closer, and validates the science. Faster enrollment means potentially getting to market sooner. The market loves that kind of progress.
Okay, clinical validation. Makes sense. Next up, a name tied directly to that AI infrastructure theme, Bloom Energy, BE, up plus 26.27%. This wasn't just random, right? There was a specific narrative.
Absolutely tied to AI power needs. Bloom makes fuel cells, basically on-site power generation. The thesis is that these massive AI data centers need huge amounts of reliable power, maybe more than the grid can easily provide.
Right, they can't afford blackouts when training these giant models.
Yes, exactly. So Bloom is seen as a solution provider. And this week, you had analysts getting super bullish. UBS massively raised their target price. Morgan Stanley put out an $85 target, which was the highest on the street.
What triggered that analyst excitement specifically?
The big validation came from a new deal they announced with Oracle, supplying power for Oracle's AI data centers. When you get a customer like Oracle signing on, it confirms the thesis. It says, yes, major tech players do need this kind of on-site power solution for their AI build-out.
Oracle. That's a huge stamp of approval. Okay, now for maybe the most talked about stock move of the week, Intel, INTC, up almost 23%, plus 22.84%, one of its best weeks in ages. And the reason was kind of mind-bending.
Yeah, this is the one everyone was buzzing about, the NVIDIA-Intel paradox. NVIDIA, the dominant leader in AI chips, Intel's biggest rival for years, announced they're investing $5 billion into Intel.
$5 billion. NVIDIA investing in Intel. Why? Why would the leader pour money into its main competitor's manufacturing?
It tells you everything you need to know about the sheer overwhelming demand for AI chips right now. NVIDIA is basically saying, we need more chips than even TSMC can make for us, and we need them reliably.
So it's about securing supply, diversifying away from just Taiwan.
Exactly. NVIDIA is currently super reliant on TSMC in Taiwan. This $5 billion investment is a strategic move to help Intel get its advanced manufacturing processes up and running faster, particularly in the U.S. It secures NVIDIA a crucial second source for future chip production.
So less about helping Intel, more about helping NVIDIA guarantee its own future supply chain.
Pretty much. But the market read it as this massive vote of confidence in Intel's turnaround plan, in their ability to actually become a major foundry player again. A $5 billion endorsement from your biggest rival. That's powerful.
Incredible. Okay, one more big gainer. SolarEdge Technologies, SEDG, the solar tech company, up over 22%, plus 22.37%. What was the story there?
This is more about operational execution and maybe easing supply chain concerns. They announced they started their first international shipments of solar equipment that was actually manufactured in the U.S. The first batch went to Australia.
So diversifying manufacturing geographically, making things in the U.S.
Yeah, reducing reliance on potentially complex overseas supply chains, expanding their global reach with U.S.-made products. A solid execution milestone.
Okay, those were the high flyers. Now let's look at the other side of the coin, the laggards. Some big drops here, too. Who is the week's biggest loser?
That dubious honor goes to Dexcom, DXCM, the diabetes tech company known for its continuous glucose monitors. Down almost 11%, negative 10.99%.
Ouch. What happened there?
It got hit hard by a short seller report. A firm called Hunterbrook Capital came out with allegations about serious safety and accuracy issues with Dexcom's main product, the G7 monitor.
Safety issues? Like what?
The report claimed inaccurate readings were potentially leading to dangerous situations, even hospitalizations. For a medical device company, any question about safety or accuracy is poison. Investors absolutely hate that kind of headline risk.
Yeah, that sounds... Was that the only issue?
No, it was kind of a pile-on. There was also lingering unease about the recent unexpected departure of their CEO, and the short report also raised some questions about their accounting practices. So multiple hits all at once.
Okay, a tough week for Dexcom. Now, in the energy space, Hess Midstream LP, HESM, down over 10%, and that is just 10.44%. What drove that? Sounds like a customer issue.
Textbook customer concentration risk. Hess Midstream basically pipelines and processes oil and gas, primarily for one main customer in the Bakken Shale region, Chevron.
Ah, okay. So what did Chevron do?
Chevron announced it was scaling back its drilling activity in the Bakken, cutting its rig count from 4 down to 3, because Hess Midstream is so reliant on Chevron's volume that immediately forced Hess to lower its own growth forecasts.
Just one rig change by one customer tanks their outlook.
Pretty much. They said earnings would likely be flat in 2026, and they had to suspend work on a planned gas processing plant. Shows the danger of having all your eggs in one basket, customer-wise.
Right. Okay, another big drop. FactSet, FDS, the financial data firm, down a whopping 20%, negative 20.09%. We don't have the specific details here, but a drop that big usually means one thing, right?
Yeah, a 20% haircut for a quality company like FactSet almost certainly points to a really disappointing quarterly earnings report, or more likely, a significant cut to their future guidance. Something spooked investors badly about their near-term prospects.
Maybe suggesting their clients, financial firms, are pulling back on spending, connecting back to that fragility theme.
Could be, or it could be company-specific execution issues. But
Yeah.
yeah, drop that big often signals wider concerns.
And finally, circling back to housing, we mentioned Lennar, LN, earlier, needing more incentives. They finished the week down over 4%, negative 4.2%.
Right. They missed on revenue and profit for their third quarter. And their CEO explicitly blamed the soft housing market and the need to use those profit-eating incentives just to close deals. It confirms that weakness we talked about in the macro picture.
Okay, so these individual movers really paint a picture. But underlying a lot of this, especially the tech winners, is this theme you keep mentioning, the AI infrastructure gold rush. Let's talk about the scale of this.
It's hard to overstate. The amount of capital being poured into building the physical and digital infrastructure for AI is just monumental, and it creates this interconnected ecosystem.
Like the NVIDIA Intel deal, that wasn't just about two companies, it was about the entire ecosystem needing more capacity,
Yeah,
right?
exactly. NVIDIA, the leader, needs more chips than its primary supplier can make. So it invests billions in a rival, Intel, to guarantee future supply. It shows the demand is so intense, so urgent, that traditional competitive boundaries are blurring. Securing supply is paramount.
And you see the ripple effect down the chain.
Clearly, look at the sequence. Alphabet hits $3 trillion, partly driven by AI cloud demand. That success means they need more and more powerful chips, driving massive orders for NVIDIA.
Okay.
NVIDIA's success then drives demand for cloud platforms like Oracle's, because companies need somewhere to actually run these AI models that use NVIDIA's chips. Oracle reported soaring demand for exactly that.
Got it. Alphabet needs NVIDIA. NVIDIA needs Oracle.
And then Oracle, building out these huge data centers, needs reliable power, which leads them to make deals with companies like Bloom Energy for on-site power generation. So Bloom's stock pops. It's a chain reaction.
A whole value chain feeding itself, driven by AI demand.
And it seems, for now at least, somewhat insulated from the broader economic concerns like the labor market slowdown. The spending here feels almost non-discretionary for these big tech players.
We saw other big tech deals reinforcing this too, right? PayPal and Google.
Yeah, another significant one. PayPal announced a big multi-year partnership to use Google's AI and cloud tech. And importantly, PayPal's Braintree payment platform is going to become a key payment processor for Google Ads and the Google Play Store.
That sounds like a huge win for PayPal in terms of transaction volume.
Massive potential volume, yeah.
Yeah.
Shows how AI and cloud capabilities are becoming table stakes for partnerships even in finance.
And briefly, Tesla. Not directly AI infrastructure, but a big move there too.
Yeah, Tesla got a nice boost, actually erased its year-to-date losses at one point. The catalyst was CEO Elon Musk disclosing he'd bought another $1 billion worth of Tesla stock.
$1 billion. Insider buying on that scale definitely sends a message.
Sends a strong signal of confidence from the very top, yeah. Market likes seeing that.
Okay, before we leave the company news, we have to touch on the geopolitical stuff. It always seems to be lurking in the background, especially U.S.-China.
Always. It's a constant overhang. This week, we saw China's market regulator make a preliminary anti-monopoly finding against NVIDIA.
Against NVIDIA specifically. Retaliation.
It's widely seen that way, yeah. Likely retaliation for U.S. restrictions on selling high-end chips to China. It adds another layer of regulatory risk for NVIDIA's global business.
And the TikTok situation is still ongoing.
Very much so. The deadline for ByteDance, TikTok's Chinese parent company, to sell off the U.S. operations is getting closer. And this is all happening while high-level trade talks were apparently taking place in Madrid. So, lots of tension just below the surface. Geopolitics could flare up anytime.
Always something to watch. Okay, let's shift gears in part 4 and look at commodities and currencies. A bit of a different story here compared to stocks. Starting with gold, huge week for gold.
Massive week. Gold absolutely surged, hit a new all-time high, briefly touching $3,707 an ounce. Settled the week still way up, around $3,680.
$3,700. Wow. What's the main driver? Still the Fed cut.
That's definitely part of it. Lower interest rates make gold, which doesn't pay any yield, relatively more attractive compared to bonds that now offer less interest. It reduces the opportunity cost of holding gold.
Makes sense. But is it just rates? Or is there something else going on? Seems like a pretty big move just for a 25 basis point cut.
I think there's more to it. It also reflects that persistent anxiety we talked about. One, sticky inflation. The Fed's cutting, but inflation isn't dead, so maybe gold feels like a better store of value.
Okay, inflation hedge.
And two, arguably the bigger driver right now is concern about systemic fiscal risk. Government debt levels globally are incredibly high. You have people like Ray Dalio constantly warning about it. Gold often acts as that safe haven asset when people get nervous about government finances or potential currency debasement down the road.
So Fed cut plus inflation worries plus debt worries equals record gold prices.
Pretty much sums it up. A potent combination right now.
Okay, now let's look at the energy complex. Oil and gas. Totally different picture here, right? They were under pressure.
Yeah, a real contrast to the stock market's optimism. Both major crude oil benchmarks, Brent and WTI, finished the week lower. Brent was down around $66.77, WTI near $62.70.
Did the geopolitical stuff, like that Israeli strike in Qatar, give any support?
Only very briefly. That risk premium faded pretty quickly. What really weighed on prices were signs of supply being plentiful, and more importantly, signs of weakening demand.
Weakening demand. How did we see that?
A key indicator was a surprisingly large build in U.S. inventories of distillates. That's things like diesel fuel and heating oil. Those are closely tied to industrial activity and trucking. When those inventories build up, it suggests economic activity might be slowing down.
So the energy market is maybe flashing a warning sign that conflicts with the stock market rally, supports the Fed's caution.
Exactly. It fits more with the fragility narrative than the booming growth narrative.
What about natural gas? Also down.
Sharply down. Fell to a 3-week low, around $2.90 per MMP2.
What drove nat gas lower?
Pure fundamentals. The weekly storage report from the EIA showed a much bigger injection of gas into storage than expected, 90 billion cubic feet.
Meaning supply is outpacing demand.
Yep. Plus, weather forecasts are calling for a pretty mild autumn across much of the U.S., which means less demand for heating fuel. Inventories are already well above average because production's been so strong. So, plenty of gas around, not enough demand right now. Prices fell accordingly.
Okay, so commodities giving a much more mixed, maybe even cautious signal than equities.
Definitely a different vibe over there.
All right, let's look forward now in part 5. What's coming up in the week ahead? We're sitting at these record highs in the stock market, so the incoming data feels even more crucial, right?
Absolutely critical. All eyes are back on the data, especially inflation, to see if it validates the market's optimism or throws cold water on it.
What's first up on the economic calendar?
Tuesday, September 23rd, we get the flash PMIs, the S&P Global Purchasing Managers Indexes for both manufacturing and services for September.
And why are these important?
They give us the first real snapshot of how business activity looked across the whole economy during September. We'll be watching to see if manufacturing is stabilizing or still contracting, and if the services sector is holding up or starting to cool off too. It's a timely read on momentum.
Okay, PMIs on Tuesday. But the big one, the main event for the week, is Friday, right?
Friday, September 26th. This is the one everyone will be waiting for. We get the August Personal Consumption Expenditures, or PCE, price index.
The Fed's favorite inflation gauge.
Exactly. This is the measure they officially target and watch most closely.
And within that report, the number everyone will dissect is core PCE.
Core PCE, absolutely. That's PCE inflation, excluding the volatile food and energy components. It gives, theoretically, a better sense of the underlying inflation trend.
So what are the stakes for that core PCE number on Friday?
Huge stakes. If it comes in cooler than expected, it reinforces the soft landing narrative, boosts hopes for more Fed cuts, and could easily send the market even higher.
Okay, good news for the bulls.
But if it comes in hotter than expected, showing inflation isn't cooling as hoped, that could be trouble. It would challenge the rationale for the recent rate cut, reignite inflation fears, and could potentially trigger a pretty sharp pullback from these record levels. Friday's PCE is a major potential pivot point.
Got it. High stakes on Friday's inflation data. Now, beyond the macro, we also have some really important earnings reports coming up. Key companies giving us updates.
Yeah, a couple of big ones that give us insight into crucial parts of the economy.
First up, Tuesday after the market closes, Micron Technology, MU.
Chipmaker.
Yes, Micron. This is super important as a health check for the memory chip market, DRAM and NAND flash memory that goes into everything from PCs and smartphones to data centers.
What will you be listening for in their report and call?
The key is their forward guidance. Are memory chip prices finally starting to recover after a long slump? What are they seeing in terms of demand from AI data centers, which need tons of memory? And is the PC market showing any signs of life? Their commentary echoes across the entire semiconductor space. Okay, Micron for the tech pulse. Then on Thursday, also after the close, we get Costco, C-O-S-T, checking the consumer pulse.
Exactly. Costco gives you this fantastic read on the health of the U.S. consumer, particularly that middle to upper middle income bracket. Their shoppers tend to be pretty resilient.
What specific metrics beyond just sales are important for Costco?
You want to look at membership renewal rates.
Mm,
Are people still finding value in paying that annual fee? That's a key loyalty metric. Also, store traffic trends. And crucially, listen to what management says about inflation. How are customers reacting to prices? Are they trading down, buying less bulk? Their insights are invaluable.
Great context. Any other earnings of note?
A few others, yeah. AutoZone, AZO, gives a read on auto parts demand.
Yeah.
KB Home, KBH, gives another perspective on the housing market. And Accenture, ACN, gives insight into corporate IT spending and consulting trends.
Okay, and which stocks specifically will likely be most sensitive to all this news flow next week? Still the AI leaders.
Oh, yeah. The AI Trinity, as some call it. NVIDIA, NVDA, TSMC, TSM for the chip manufacturing link, and Alphabet, GOGL, for the cloud AI application side. They will react instantly to any major headlines about AI spending, new partnerships, or, of course, any new twists in the U.S.-China tech tensions. Their leadership is key to the current rally.
Makes sense. And maybe a quick technical or signal thought as we head into the end of September?
Yeah, it's worth remembering that September, historically, is the single weakest month of the year for stock market returns. We're heading into the very end of it and then into October, which can also be volatile.
So seasonality isn't exactly a tailwind right now.
Not really. Combine that historical weakness with the market at record highs and the huge importance of Friday's PCE data, it just raises the potential for some volatility. If that PCE number disappoints, the market could be vulnerable to a pullback given how far it's run.
Good caution. And one last quick note for income investors, ex-dividend dates.
Yeah, just a practical point. Monday, September 22nd, sees a whole bunch of companies trading ex-dividend. That means you have to own the stock before Monday to get the upcoming dividend payment. We see names like Bajaj Holdings, Maharashtra Scooters, mentioned often a mix of international and domestic firms. It can sometimes influence flows for income-focused funds around those dates.
Good practical tip. Okay, let's try to wrap this all up in the outro. Let's synthesize this packed week.
Sounds good.
So the main story, a week where markets hit massive new records. The S&P 500, the NASDAQ, powered higher by the excitement around the Fed's first rate cut in a while.
Right, and that excitement clearly fueled the AI-related stocks. Tech and communication services were the huge winners, pulling capital away from defensive sectors like real estate, staples, and utilities. A classic risk-on rotation.
But, and this is the core tension we keep coming back to, that market euphoria is sitting on top of some really conflicting economic signals.
Exactly. The very reason the Fed felt compelled to cut rates was weakness, specifically in the labor market, highlighted by that enormous 818,000 downward revision to past job growth.
So weak jobs data justifies the cut.
But meanwhile, core inflation is still stubbornly above 3%, which argues against cutting rates. And consumer spending is holding up, but housing is weak. It's a messy picture.
The market seems laser-focused on the upside of lower rates, boosting valuations, supporting growth stocks, and kind of ignoring the potentially worrying reason why rates were cut. It's all about the soft landing hope.
It's overwhelmingly pricing in that perfect Goldilocks outcome.
Which brings us to that final insight, the kind of provocative thought for you, our listeners, to mull over heading into next week.
Yeah, the central question really becomes this. We have a Fed cutting rates explicitly because of surprising fragility in a key part of the economy, the labor market. Yet we simultaneously have a stock market soaring to all-time highs, seemingly betting that the economy is strong enough or that the AI theme is powerful enough to overcome any underlying weakness.
So can both be true?
That's the million-dollar or maybe trillion-dollar question right now. Is this AI-driven bull market now fundamentally disconnected from old-school macro indicators like jobs reports? Is the sheer scale of AI investment creating its own economic reality immune to broader slowdowns? Or is the market's current euphoria just a temporary sugar high based on the rate cut itself, dangerously ignoring the fragility that prompted the cut? If that labor market weakness deepens, or if inflation stays stubbornly high, can these record valuations hold? That disconnect market strengths versus the Fed's cautious justification is the key tension to watch.
A fantastic question to ponder. Is the AI boom strong enough to defy economic gravity, or is the market ignoring warning signs? We'll certainly be watching closely.
Absolutely.
Thank you for joining us for this deep dive on the bulls, bears, and the bell weekend edition. We hope this breakdown helps you navigate the week ahead. We'll track those catalysts right alongside you.